24 seconds away from the opening bell this morning. Good morning to you all. Just about putting together some back-to-back gains on the S&P over the last couple of days. Right now, negative 0.5% on the S&P 500. On the Nasdaq, we're down about 0.5%. Bit softer, lighter, lower going into a big earnings afternoon after the close a little bit later with Google and Microsoft to kick things off for Silicon Valley. There's the opening bell that kicks off the trading session. Here's the bond market. Yields lower by 5 basis points, 343.72. Just some of these regional Fed indicators weighing on this bond market, fueling a bit of a rally over the last couple of days. Dallas Fed yesterday, Philly Fed this morning. We're down 5 basis points on a 10-year maturity. Just to pick on the 2-year, we're down 5 basis points there, just about holding on to a 4 handle on 2s. North of 4% all through last week, and just about this morning at 4.04% on a 2-year. In the FX market, touch of dollar strength, euro weakness, holding on to 110, euro dollar 110.14. We're negative 1/3 of 1%. About 30 seconds into the session, we're down here on the S&P 500 by 0.4%. On the Nasdaq by 0.6. If you want to see some major price action though, check out this name. First Republic, recording its biggest intraday drop in more than a month after reporting a massive decline in deposits. The CFO said this: with the closure of several banks in March, we experienced unprecedented deposit outflows. We're working to restructure our balance sheet, reduce our expenses and short-term borrowings. Katie Lyons, this is a difficult morning for that bank.
It is. The stock dropping 25% in the first few minutes of trading here, but they, of course, reported an even larger deposit drop than that. 41% in the first quarter, deposits falling to just $104 billion. The street was looking for $137 billion. So, yes, it was a big miss, also compounded by the fact that that was even with a $30 billion deposit inflow from larger banks who were attempting to stabilize First Republic last month. Now, as for the other highlights, they have said that deposits have stabilized to this point. That doesn't necessarily seem to be shoring up confidence this morning. And as you said, trying to reduce the size of its balance sheet, moderate loan volumes, and cut costs by reducing as much as 25% of its workforce, as well as exploring strategic options. So this is the bank clearly still struggling in the aftermath of the SVB and Signature Bank failures and the crisis of confidence in regional banks. However, it seems to be suffering even worse from that crisis of confidence, which perhaps is exacerbated by the fact that executives didn't take any questions on the earnings call amid that ongoing crisis. First Republic now down 90% year to date. Regional banks more largely still down about 29% in 2023. Of course, both of those dramatically underperforming the wider financial sector. But First Republic, John, it's an ugly chart to look at.
It's a tough morning. It's been a tough year, that's for sure. Kelly, thanks for that. I talked about some of the research coming from the South Side and mentioned specifically that note from Jenny Montgomery Scott. Here it is. They downgrade the shares to a sell. They write this. Pretty punishing, brutal language, to be honest with you. First Republic results were far worse than we expected, and we believe the company, here's the line, needs to pull off the mother of all pivots to survive. That stock is down 27% in early trading. Another bank reporting across the other side of the Atlantic, we mentioned UBS, they're actually paring their declines right now after falling more than 5% a little bit earlier in Swiss trading. The Swiss lender writing in a statement this: while concerns about the stability of banks have abated, they have not gone away. As a result, client activity levels could remain subdued in the second quarter of 2023. Shinali, great to catch up with you, because when you put this all together, we might have avoided the worst of it for some of these names, but ultimately it's going to be a challenging year ahead for them still.
It certainly is, but remember, the reason they're pairing their gains in the market, John, is because you have UBS coming in with the mother of all deals here. They're about to have the biggest charge here, a negative goodwill charge of more than 51 billion Swiss francs, because they bought Credit Suisse so cheaply. But listen, the numbers themselves, I think you have to notice the pressure on the numbers here. The global wealth management revenue coming in below expectations, and even on the investment banking side, equities coming in below expectations. It tells you two things. One, even the world's wealthy are not immune to tough times. Even though net new money is up, the revenue, again, because client activity is down, is underestimated. Estimates, I'm sorry about that. But the equities trading, the reason it matters, remember, we're one prime broker short in the world now without Credit Suisse. So UBS, as it caters to that investment banking business, can they gain share? This is a bank that has avoided risk very significantly since the last financial crisis. We're going into tougher times. Can they compete with the European banks as well as the U.S. banks as they integrate another behemoth? I think that is the big question as we look to years ahead for these two firms.
They're certainly going to try. Shanali, wonderful coverage, not just this morning, but over the last few weeks as well on the financials, the last few months for that matter. That's UBS. Let's talk about UPS. That stock is down in early trading by almost 8%. They're projecting annual sales to come in at the low end of its guidance as demand continues to decline. Here's the update from the chief executive, the CEO, writing this. A deceleration in US retail sales resulted in lower volume than we anticipated, and we faced ongoing demand weakness in Asia. We expect volume to remain under pressure. Abby, not looking good for them this morning.
Not looking good at all. In fact, we're looking at the worst day right now for UPS going back to October of 2020. As you mentioned, the stock sliding by almost 8%. The quarter that they just reported basically in line, a little bit of a miss for sales, but it has everything to do with guiding toward the bottom of that outlook, as you were just mentioning, the company talking about the weakness that they're seeing in demand. So what goes up must come down. We have the pandemic trends, some of them reversing, lots of e-commerce back then, maybe less so now. They're talking about weak U.S. retail sales and that they're seeing weaker demand. So again, they're at the lower end of their guidance for sales. In the quarter that just was, while on the surface basically in line, operating profit margins did fall 11% from 14%, so maybe not managing cost all that well. In addition, while the domestic revenue per package rose by nearly 5%, the parcel volume, not surprisingly, down 5%. They have a looming possibility of a strike. They have to negotiate a contract of 330,000 workers by the end of the year. The stock had been, wow, what a chart there. The stock had been up more than 10%, now just up 3.4%. I wouldn't say it was priced to perfection before, but maybe you could say that, John, given the fact that now it's almost even on the year, really eating into that massive gain that it had.
Getting punished. Stock's down 8% on UPS. Here's a stock up almost 8%. It's positive 7.5% right now. Spotify rising after posting double-digit subscriber growth. Ed Ludlow joins us now on the West Coast for more. Morning, Ed.
Yeah, good morning, Jonathan. Subscribers coming in at 210 million, 15% gain above street expectations. Monthly active users in at 515 million, breaching that 500 million mark again above expectations. Real momentum in the quarter. A narrower or shallower than expected loss of $172 million. The only area or metric where they missed was on the top line. But actually, if you read across the sell side reaction this morning, the aggregate of all of the metric beats make that sales growth an afterthought. They also gave a pretty bullish outlook for the current fiscal second quarter, where they did state that revenue would grow to 3.2 billion euros. A lot of momentum around podcasts, a lot of momentum and profitability profile around music, especially at a time where like Apple Music and some of their peers, they're raising prices. So they were able to grow their subscriber base, their monthly active user base, and then forecast that will continue sequentially. That's got a lot of the street very positive. Up more than 8%, on track for his biggest gain since the end of January, Jonathan.
Ed, you mentioned Apple. Next week, Apple earnings. Let's talk about how busy you and Caroline Hyde are going to be over the next couple of days. Later, Google and Microsoft. Tomorrow, Meta. Thursday, Amazon. Give us the guide, Ed. What are you looking for a little bit later?
Yeah, look, the broad theme is that, on an EPS basis, we're going to see earnings have their biggest drop since 2009. Across information technology on the S&P 500, a pullback of 15%. Those names on your screen, broadly what they're saying is we're worried about the bread and butter businesses, the core businesses, and how they are going to fare. In Microsoft's case, cloud and enterprise software, Alphabet search. What we're looking for is A, what was the action of layoffs and cost cuts to the bottom line in terms of margin protection, and then B, are there some saving graces? So you take Alphabet as an example. We're worried about that core search business, but does Google Cloud then step up and save the day in a way that AWS has done for Amazon in the past?
Big effort for the Bloomberg technology team. Coverage starts in a couple of hours on Bloomberg TV. Looking forward to it, Ed, alongside Caroline Hyde. The broader market right now, 9 minutes into the session, we're negative 0.4% on the S&P 500. Earlier on this hour, you heard from Luke Hickmore and others from Aberdeen talking about the potential for yields being lower. Let's talk about the potential for yields being higher. Katie Kaminsky of Alpha Simplex going short bonds and saying this: we may see a risk of a strong curve steepening and sell-off in bonds later this year as investors face the realities of higher inflation for longer. Katie Kaminsky joins us right now. Katie, wonderful to catch up with you. I've been looking forward to this all morning. Let's start there. The argument from here for higher yields, Katie, what is it?
Well, if you have to think about inflation tolerance, so if the Fed actually pauses and inflation is higher than target, just in basic mechanics, that affects long-term cash flows. If that's the case, at some point, people might start to realize that longer-term debt is not worth as much as what it is today if we don't have cuts quickly. And I think that's something that people are underestimating because they're just hoping that everything's just going to stop and go back to normal. And I think that they're ignoring the risks in the bond market.
Being actively short is very different to just not being long. Now, Katie, I wonder if these massive swings over the last few months make it difficult being actively short this market. How do you go about doing that?
Yes, this is a good point. I mean, let's just be honest. We saw one of the biggest shocks that we've seen and one of the biggest bites for short positioning earlier in March when you had that flight to safety. But on the other hand, we might be ignoring the long end of the curve, which could have potential to move if we see inflation for a longer period of time. And I think most investors are hopeful that inflation will come down, hopeful that a Fed pause will be nice to the equity markets, and that will waver this. But I think where you'll see the catalyst of problems is when you actually see the fixed income markets have trouble later in the year, which could predate any sort of equity drawdown.
So, Casey, let's assume you're right. Let's work with that. High yields and do some scenario analysis through other asset classes. Let's push it through equities first. What would you expect to happen with equity leadership off the back of the call that you're making in the bond market?
Well, so first we're going to see a steepening of the yield curve. That means that people lose confidence in the valuation of long-term cash flows, which then affects discount rates, which kind of shows that lending is even more expensive. That's going to put tightening on equity markets, which would cause a lot of problems. On the other hand, it might create the desired results that the Fed is looking for to actually de-inflate assets and then put us in the right place. Unfortunately, that's not a very fun scenario for most investors. If we actually see a drawdown in both equities and fixed income, that's what we had last year, and it's not a very pleasant experience for the 60-40.
Just to recap some of the price action right now, First Republic down 29%, record low on the stock. Brutal stuff. Is trading in and around 11 off the back of earnings yesterday. Deposits much lower than anticipated. The idea that things have stabilized since the first quarter, not enough to encourage any gains in this stock this morning. They had an earnings call yesterday, no questions. The stock is down by close to 30% and struggling to bounce. Katie, how do you think about the financials and how they're involved in the call that you're making currently?
Well, let's take a look at what happened. So when we go back to what happened in March, we really saw people start to realize time value of money has changed. The value of bonds, cash flows, my deposits, they need to be different in this environment with higher inflation. And now that I have attractive rates, maybe I'll start actually thinking about shifting money around. And so if you look at what's happened in the banking crisis, you're going to see more of this type of problem as people deal with duration mismatch, cash management, in a world with much higher rates and an inverted yield curve.
Is this a time to buy gold?
Good question. Gold has really rallied on this move, and it is one of the safe haven assets that's actually moved when the dollar didn't move like a safe haven asset. So it could actually be a time where precious metals might be one of the few trends. It's one of the few signals that we're seeing from a technical perspective that precious metals are something that people are buying because they may say, what else do you buy in this situation?
Well, Casey, what would you advocate for when you take exposure to precious metals? Would you do it directly? Would you do it through miners? What would you do?
Well, so you can take direct exposure via ETFs or via futures. There are also indices which investors can take exposure in as well. If they think that they don't want to just park cash, that's something that investors can actually look into for these days with ETFs in particular.
Katie, just out of interest, when was the last time you advocated for a position in gold?
I think pretty often when there's some sort of safe haven trade, gold has been interesting. I mean, metals, to be honest, have been more of a base metals trade in the last 2 or 3 years. So it's been the first time that we've actually started talking about gold, platinum, palladium. It's because those assets were less active in an inflation environment, but more active in a recession, in a recessionary question environment.
Through 2K in the last couple of weeks, backed away since then, just south of that number right now. Katie, wonderful to get your perspective on things. Katie Kaminsky there of Alpha Simplex taking the other side of that trade. Luke Hickmore was talking about lower yields. Katie's talking about the prospect of high yields and a range of outcomes more broadly cross-asset for that. The equity market, first of all, we're down about 0.33%. On the Nasdaq, negative 0.4%. Outside of that, in the bond market right now, yields lower by 7 basis points. Dallas Fed manufacturing yesterday softer. Philly Fed, that number this morning came in softer too. So bonds are rallying. Outside of the bond market, just the one that gets your attention, First Republic, it's pretty tough. Stock is down by 29%. And moments ago, a record low. Coming up, President Biden making his 2024 run official.
Let's finish this job. I know we can. Because this is the United States of America. There's nothing, simply nothing we cannot do if we do it together.
That conversation up next.
The question we're facing is whether in the years ahead we have more freedom or less freedom, more rights or fewer. I know what I want the answer to be, and I think you do too. This is not a time to be complacent. That's why I'm running for re-election.
Finally, the President of the United States officially launching his re-election bid, setting up a possible rematch against GOP frontrunner Donald Trump. This as Biden remains locked in a standoff with Speaker McCarthy over the debt ceiling. Bloomberg reporting McCarthy's bill will hit the floor this week under a rule that doesn't allow amendments despite falling short of the Republican support needed for it to pass. Team coverage begins right now with Anne-Marie in D.C. alongside Katie Lights. I want to start with you, AMH. The latest, finally, he got there. I think we've been waiting for this official announcement from the President of the United States for the best part of 6 months.
Yeah, Jonathan, if there's any confusion, Joe Biden is seeking re-election and he's running for office in 2024. He's going to be the undisputed candidate, right? He's the president of the United States, and this is just him making it official. But with a highly produced video, this isn't a campaign event. But what it does do is it sets Biden up to now start fundraising. He just also filed in the last hour FEC paperwork, the Federal Election Commission, so he can start talking to donors. He has a campaign team that's going to be set up as well. So now he's really starting to ramp up into 2024. The big issue he's going to have as he seeks re-election is 2020 was really about, and you talked about this earlier, a referendum on former President Donald Trump. And at the moment, they are trying to again make 2024 about President Donald Trump. But at this time, he's also going to have to defend his last 4 years. And that's really where Republicans are going to want to strike attacks, most notably on the economy.
Well, let's talk about his age because it keeps coming up. 70% of all Americans, according to this poll from NBC News, including 51% of Democrats, don't want Biden to run for president in 2024. The major reason, nearly half of those respondents cited his age as a major reason. MH, this has been somewhat frustrating for me because people describe this as the elephant in the room. And we put all 80-year-olds of the country into one bucket and say that they're not capable of doing a job. And I think actually the real elephant in the room is not that the president is 80 and will be 86 at the end of his second term. It's whether you believe he is someone at 80 that does not have the capacity to do this job. Because that's not true of everyone in older age. Is it true of this individual?
Well, listen, he has had a very difficult in terms of traveling schedule over the past 2 years of his presidency. This is someone who has had huge trips around the world and is able to land and go into these difficult meetings. And at the moment, when you talk to people on his team and you see the president out and about and talks to reporters, his age has not hindered him. We should also know in that NBC poll, Jonathan, a lot of people also don't want to see just a rematch in general of the former president, who is only 4 years younger than the current president. So President Donald Trump and President Biden both in the older age. And a lot of people are just, the whispers are about fresh faces really for both parties. But at the moment, that is going to be something that Biden says, I was able to do it. I proved myself, and watch me, I'll do it again. Age, he understands, is a factor, but he says he's healthy right now and he's ready to take on 2024.
Kayleigh, before we deal with 2024, we've got to deal with this year before we get to next year. The debt ceiling debate, the kind of economy that we'll be talking about through the campaign and into next year. Where are we on that front now, Kayleigh?
Well, of course, the X date is drawing closer by the day. Now, in D.C. today, later on this afternoon, Speaker McCarthy's $1.5 trillion debt ceiling raise proposal will go to the Rules Committee. That's not going to see any changes to the bill. It will just set the floor procedures, because our reporting here at Bloomberg indicates that both Speaker McCarthy and his top lieutenants have told their fellow Republicans this bill will go to the floor as is. They are not going to change it, despite different members of the Republican caucus raising issues on things like the ethanol tax credits as well as work requirements for social programs. So there is still a question as to whether Speaker McCarthy can get the 218 votes that he needs. But Henrietta Trey's over at Veda Partners this morning says that actually the timing of Biden's announcement may be working in McCarthy's favor here. She wrote, the tone in D.C. is increasingly optimistic that McCarthy will get this bill passed, because McCarthy is corralling his members this morning around Biden's re-election announcement. It is now their base case that this thing will go through. Then it becomes a question of whether or not the White House and Democrats are going to be open with negotiating with McCarthy should he get the votes to pass his bill.
Hey, Kayleigh, thank you. Alongside Anne-Marie, the update from Washington, D.C. The broader market right now, 23 minutes into the session, we're negative 0.6% on the S&P. Coming up very shortly, your trading diary. Before we get there, First Republic right now in early trading, trying to bounce down 29% lower, record low. Almost 26 minutes into the session, we are negative 0.6% on the S&P and the Nasdaq. A similar move on the Russell of small caps struggling. Your trading diary looks like this. Alphabet and Microsoft earnings at the close, followed by Meta on Wednesday, Amazon Thursday, plus US GDP and another round of jobless claims. On to Friday, PCE inflation, UMich consumer sentiment and personal income and spending data to round out the week. That rounds out the morning for me. Thank you for choosing Bloomberg TV. As always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Stay like Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Into the U.S. trading day, Tuesday, April 25th. Here are the top market stories that we're following for you at this hour. Earnings not so bad. A slew of companies stick to the playbook of beat and raise. Equities, though, a bit softer. We're going to find your earnings playbook with David Kostman, Goldman Sachs. And Lay's, Quaker Oats, and soda. Pepsi delivering a strong beat in organic revenue this year, could be as high as 8%. We're going to talk to the CFO, Hugh Johnston. And consumer confidence and credit. April's consumer confidence breaks right now. We're also going to look ahead to Visa after the bell. We may still be spending. The risk is it's on more credit. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. So are we spending? Am I spending?
Your consumer confidence maybe a little different to the data we're seeing on the board in front of us, actually, Alex. What I think is really interesting is that Pepsi's looking really good. Coke looked really good yesterday. Nestle looks really good. European industrials are also looking good, but the consumer names look really strong. New home sales plus consumer confidence data. Let's get a macro read, but I think today's really about the corporate story, Alex. So new home sales come in way above expectations at 683,000. That's up from 640, way better than the 632 that we were expecting. And the month-on-month number bounces back to 9.6. My question is, if housing comes back, does that give the consumer another boost? And at what point do we start to feel that?
Yeah, or have we already just gone through the cycle for housing, right? That was the 2022 story. Is this year going to be more about autos, and then we kind of move forward to different sectors? The consumer confidence number really interesting for April. So overall, it falls a touch. But the present situation rose quite significantly to 151.1, but expectations fell. So expectations are now down to 68.1. So future still murky, but right now we feel good. That very much feels like what we're hearing from a lot of CEOs on earnings calls. They're really worried about stuff in the future. They just don't know when that's going to hit, but they're not seeing anything right now in the numbers.
It's really interesting. We've been talking about this narrative for a while. I remember Ralph Schlossstein talking about this a while ago, talking about the fact that when you talk to individual companies, they actually feel pretty good. When you ask them about the macro picture and they're listening to people like us, they feel a little less confidence. But we're all waiting for the headwind of earnings, really, to start to be felt. Everybody anticipated that it could be this quarter. Maybe it was last quarter. We didn't get it in either quarter. And certainly this quarter is shaping up to be fairly good, Alex. So our question of the day is a straightforward one. Alex was hoping I'd be moonwalking at this point, but that ain't going to happen. Do you dance to the earnings beats? Beats, maybe, is the way of articulating that a little bit better, because the earnings story is coming through pretty good so far. I know there are some sort of idiosyncratic exceptions. You take a look at what's happening with First Republic today, but broadly, the earnings story looks pretty good. Let's try and answer that question, therefore. Kriti Gupta, Jess Menton, joining us now to discuss. Kriti, let me start with you. We've been waiting for the earnings headwind to hit. Doesn't feel like it's going to be this quarter. The question is, should investors therefore chase companies that are doing well, or is this as good as it gets?
Well, it depends on if you are actually wanting to make money off these individual stocks, in which case, yes, dance away on these earning beats. But look, if you're looking at it from a macro lens, looking underneath the hood is really crucial here, because yes, they are earnings beat. And I'm going to use a quick case study here. PepsiCo, for example, you have the CFO on shortly in I think about an hour's time or so. They're actually showing that volumes are decreasing. You're seeing the same story with the likes of UPS, for example. Volumes are decreasing, but the marginal income that you are making on every additional unit, whether it's a beverage, a can of soda, or whether it's an actual package, that is what's increasing. So on the kind of bottom line, margins are getting better and better, and that is good news for equity investors who are purely looking at the equity market and those particular stocks. But if you are a consumer, or if you are the Federal Reserve, this is not great news, because it means as you increase those prices and the consumer shows that, well, they can take it and they're willing to spend despite those price increases, that just means that most of corporate America is going to stick to those higher prices, creating an element of sticky inflation that's going to stay there no matter how hawkish the Federal Reserve gets.
Which is so nuts, because I feel like the conversation headed into earnings season is that the top line is going to be at risk, margins are definitely getting squeezed, and that conversation isn't yet playing out. Jess, I'm curious as to how do investors dance to the earnings beat, but we'll have to look at positioning of what they were positioning for, what they were dancing for into earnings.
Well, everyone has been talking about an earnings recession, but if you look at the S&P 500 and you exclude energy, because that obviously had a boost last year because of that correlation with commodity prices and inflation, the S&P 500 earnings, they had been in a recession since the second quarter of last year. So when you look at those projections for the second half of this year and next year, those are going to be in double-digit growth from a year from now. So if you're an investor, you're looking 6 months out, 12 months out, that's what they're looking at. So if you're thinking about where they were standing last year, they were already seeing that negative growth. So you actually are seeing an improvement there.
Interesting.
So we passed the worst, Jess. A lot of people are trying to figure out whether this market takes another leg lower. They're predicating that on the fact that the earnings hit is still yet to come. Maybe what we're actually looking at in reality is that it's already passed.
Exactly. And to Kriti's point when she was mentioning margins, the big thing is, as far as when you're looking at the Wall Street consensus, and this is Bloomberg intelligence data, the margin low could potentially be past us, especially when you're looking at the first quarter. So when you're thinking of companies like Procter & Gamble, those more consumer-oriented companies that analysts were expecting that they really needed to beat and see that margin low, we're starting to see that improvement. We're going to hear from more companies like Kimberly-Clark, Clorox next week as well, Church & Dwight. So that's going to be really key. Obviously, we're going to talk so much when it comes to the technology and the growth companies, but when you're looking at these more consumer-oriented companies, they are seeing those margins improving right now.
So, Kriti, is this enough to re-risk the market, or are we just not going to de-risk?
We're not going to de-risk, and I think the reason is that context is everything here. Essentially, the idea that when you look at the trading range that the S&P 500 has been on, I think there's a stat somewhere on the Bloomberg terminal, I think by the folks on Jess's team actually, who said this is the slowest kind of trading range you've seen going all the way back to 2017. And the reason is because if you actually look at a broader S&P 500 chart, the stock market broadly has been trading sideways, and a big reason for that is simply because that earnings recession that Jess was just talking about, or even the economic recession that everyone is saying will be Fed-induced and just around the corner, whether that's July or out into 2024, 2025, was largely priced in by the equity market. The carnage that we saw in 2022 was pricing in this scenario. So now you are really looking forward to that expansionary era that is supposed to follow the recessionary period right now. The only issue is we don't know when that starts, and that's really why you're seeing markets kind of
Okay, so Kriti, are we pricing the recovery before we get the recession?
We 100% are. We are pricing the recovery before we get the recession. I think that's a good way to put it. The problem, though, is with the recovery, you would need broader gains, and you're not seeing that. You're not seeing breadth here. You are only seeing the tech stocks, for example, do really well. A great example, actually, is if you look at 3M earnings today. They talked about layoffs, 6,000 people, 6,000 jobs on the chopping block. That's a cost efficiency story. If this was Meta, if this was Apple, if this was Microsoft, the stock market would reward that. Today, 3M shares down, and that, I think, is kind of the takeaway here, is that the tech playbook is kind of dancing to a completely different beat than the rest of these companies are. And for that reason, the entire market as a whole isn't able to sustainably move forward and price in the recovery that will inevitably come.
Which also brings us to just the VIX and how obviously it's not a good indicator of volatility. But in individual companies, though, are we seeing a lot of action, a lot of volatility within individual names? Like, is that how investors are going to be playing this earnings season rather than the broad index?
So when you're seeing companies that have been beating on EPS and revenue so far, they've actually been outperforming the S&P 500 in excess more than 1%. And when you're looking back at the 5-7-year average, that's actually below that level. So far, but we still have, if you're putting in size and scope for this week and next week for earnings, there's more than 340 companies reporting. So it's about 67% of the market cap. So when you're thinking, especially these technology companies that obviously are going to have a bigger composition of the index, we're more likely to see those big moves there. But on an individual basis, even though we haven't seen big swings in the broader index, I think we're going to continue to see those big swings in individual stocks.
Just give me a sense of how investors are reacting to companies giving them money back, be it in the form of buybacks, be it in the form of dividends. How is the market treating different companies differently as they talk about the fact that they can return money? You're getting a really good yield out of the bond market right now. How is the equity market stepping up to compete?
Well, that's a crucial pillar of support when you're thinking about the stock market and buybacks, and especially when it comes to two key groups that are reporting this week, technology and growth, but then also energy companies. We are going to have Exxon and Chevron at the end of this week reporting, and they were a key pillar when you're thinking about, especially last year, how energy companies were holding that up, as well as when it comes to CapEx, as far as how companies are reinvesting into themselves. So when it comes to the buyback picture, that's going to be a big question as far as the next coming days, as well as next week, because we will hear from Apple as well, as far as how are companies still continuing to spend on these buybacks. So if we continue to see that, more likely you're going to see investors rewarding those companies.
Great stuff, guys. Really wonderful to set us up for the next 2 hours as we dig through all this earnings stuff. Kriti Gupta and Jess Menton, thank you both very much. So coming up, more insight into the question of the day. Do you dance to the earnings beat? We're going to talk to David Costin, Goldman Sachs Chief U.S. Equity Strategist. He will be joining us next. Goldman Sachs has 4,000 for the close of 2023 for the S&P. This is Bloomberg.
earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Can we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
On the margin, I think the news is a little bit more cautious for that uptick in the end of the year. So have we pushed out a slow, shallow recession into 2024, or are we going to not get the pickup at the back half of the year that we're looking for? I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
That was Sarah Hunt, Chief Market Strategist at Alpine at Saxon Woods on Bloomberg TV earlier today. Want to get back to the question of the day. Do you dance to the earnings beat? Sarah definitely more skeptical. David Costin, Goldman Sachs Chief U.S. Equity Strategist, joins us now. David, we got the beat and raise situation. Do you dance to this beat?
Well, I think it's generous to make the statement about earnings beats. I think the right way to think about it would be that on the top line of revenue growth, you've had some positive surprises, but they are less dramatic than you've had in the past several quarters, call it last 8 quarters. And the same thing on the bottom line. If you look at the earnings per share results, they are slightly ahead of expectations, but by a lesser amount, a narrower gap than they've typically been for the last 8 quarters or so. So I think it's a kind of modest earnings season in terms of the development. That's how I'd characterize it. And the second thing I would observe is that the market is pricing the economic slowdown. Meaning if we look at the relative performance of cyclical stocks compared with defensive stocks, that relative performance is consistent with a GDP growth of roughly 1%. So basically the earnings results and the pricing action would suggest it's consistent with the economy that's kind of moving sideways.
So what do you do with that? How do you position around that? How do I dance to the beat that you're describing, David?
Well, the way I would look at it is, where is the economic situation getting better? Where are we seeing improvement? We're seeing improvement in China. Consequence of the reopening of following the zero COVID policy, lifting of that policy. So question is, how is a U.S. investor looking, and how should he or she be positioning a portfolio when there's this positive development that's happening in China, yet there's this tension geopolitically between the two countries? Well, we're looking here at U.S. companies, say metals and mining companies, that will benefit from the global demand, largely driven by China, for some of the commodities. You could think about Freeport-McMoRan, you could think about Alcoa, and the argument, Guy, is as follows, that the GSCI Commodities Index, the forecast of our commodity strategist, is that you have a 30% increase, 30% upside on the GSCI. And we know the statistical relationship and the close tracking of the metals and mining stocks here in the U.S. with that underlying driver of the commodity level is a key driver of ultimately their cash flow and their performance. So the way I would think about it is, where are things getting better? They're getting incrementally better in China, and therefore how do we invest in that as a U.S. equity investor?
David, I'm wondering though, because what the reaction to China reopening has really been, say, travel demand and luxury goods, not metals and mining.
That's why we're looking forward. You know, you ask what has happened. We're looking at what's going to happen in the next year or so. Where do we think price action is going to be taking place? You're right. The reopening of the economy has been a driver of demand for airlines and things like that. Looking forward, what's the second order effect? It's demand for metals and the pricing of metals, and that's the U.S. companies like to benefit from that.
David, when I look at copper, when I look at iron ore, they're moving in a downward trajectory right now. You're saying that that's going to turn around?
Well, I look with my commodity strategists here at Goldman Sachs, and they're looking at an idea of their increased demand, supply-demand imbalance. You get pricing moving higher, significantly, and that's really what's driving the thesis behind owning metals and mining stocks. They're reasonably valued in this environment, and cash flow generative component. That's the thesis and the investment strategy sort of underpinning our thought process. On the other extreme, if you want to think about the consumer durables here in the U.S., you've had huge moves. They're up almost 25% or so in the last 6 months, well outperforming outperforming the index, largely driven by the home building stocks. Home building stocks, you look at the headwinds, mortgage rates, 30-year mortgage rates likely to move towards 6.5%, so it's a headwind for that. So we look at price action. Again, what has happened in the market, and now want to think about what is likely to happen going forward.
So David, where does that leave then tech? Some names have been the really big outperformers as we head into earnings. What do you do with that sector right now?
Well, tech is obviously a complicated component, or if you will, a multi-dimensional component with semiconductors, different from software, different from hardware companies. You know, my view would be that the stability of the growth is what's critical, and the economy is at a vulnerable place here in the United States. Things are slowing. Uncertainty exactly the trajectory that will take place. And so software companies, Alice, would be an area to focus on. And the argument for that is that stability, stable growth would be an area to prize. So you've got some cyclical exposure on the China end, but here in the United States, you're thinking about some of the consumer staples, some of the healthcare stocks. Those are more offering you more stability, ballast in the portfolio. Think about it as a barbell strategy. That's how I would position a portfolio now.
David, I'm looking at Coke, I'm looking at PepsiCo. We're about to talk to the CFO. Nestle out of Verve today, posting some really solid numbers as well. These companies, you talk about the consumer staples, they are able to deliver pricing power at the moment. Do you think that we are reaching the point where that pricing power is going to be eroded because the consumer is not going to take any more? How much more do you think the consumer can take? I'm looking at the confidence data we've just seen as well. That looks pretty rosy in the current situation, but if you look further out, it's beginning to fade. What do you think about the consumer stocks through that prism?
Well, I think through the prism is where is their stability? The value of that is so important in this kind of uncertain economic environment. Sometimes I think about it as when do you pay for excitement and when do you pay for boredom? And I would say we should pay a premium for boredom at this environment. Now, it's not that the companies aren't doing well. They're doing great. As you said, they're beating and raising, and they're surprising, if you will, on their margin front. You're looking at dividend growth. So a more defensive posture is appropriate at this juncture when the U.S. economy is maybe growing at a 1% annualized rate right now. Earnings are down roughly 7% year over year. That's a headwind. So the consumer staples, healthcare, those offer some of the attributes. Particularly think about stable growth. That's where you can find it.
David, it's always great to catch up. We always appreciate your time. We're always interested in what you have to say and the research that you do. Thank you very much indeed for joining us. David Kostin of Goldman Sachs. Still ahead, Spotify jumping after reporting a surge in subscribers, which is interesting. More on what we can expect from big tech earnings. We've got a big week of big tech. The startup is next. This is Bloomberg.
is 22 past 7 on the West Coast. Look at that sun coming up. We're about to get to the startup. We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its pretty nice morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, to start with the earnings we got this morning, so Spotify up a nice 4%. More subscribers. That to me doesn't say we're slowing, the consumer's slowing.
Yeah, then they seem to be growing. You know, I think 210 million paid subscribers, a jump of 15%. Monthly active users breached the 500 million mark, 515 million, both above expectations. And what you're seeing is actually they missed on the top line, but investors and the sell side are being a little bit forgiving. They're saying, look at what they did to grow their user base at a time where Apple Music is raising prices, where there's more competition. They looked at the profitability of the podcast and music business, and then Spotify gave us an outlook for the current quarter that was also quite bullish. So it was, I guess, a surprise bright spot early in this earnings season.
Ed, a lot of people are talking about the fact that the bar has been lowered for many of the earnings that we're seeing coming across the tape.
Yeah.
Is that true for tech? How high or low is the bar?
It's a good question because going into this, we know where we stand. If you just take the basket of information technology stocks on the S&P 500, we expect EPS to pull back 15% year on year. In other words, earnings to drop by the most since 2009. We know what the problems are. For the likes of Alphabet, Google, Meta, there is softness in the advertising business still, and we need to know what the material impacts of their cost cutting has been. For Microsoft, we're all sort of really excited about AI, but the reality is it will live and die by the success it has in enterprise and cloud and software, and those are markets where we're seeing spending pull back. So the bread and butter businesses are once again in focus, and that's still exciting.
So, says the guy who covers tech. So bread and butter business, then what does that mean then for Google, for example? Is it all going to be ad sales? Because that's going to be under pressure.
So what's really interesting in Google's case is that, yes, on the top line, we expect softness. This could be a situation where we know where we stand with the core search business, right? There's going to be a lot of debate around Bard and what generative AI is going to do for that business long term. The short-term question that a lot of analysts are posing is, what about Google Cloud? Just like we've seen with Amazon and AWS in past quarters, could we see the same for Google, where Cloud Unit comes in with some outperformance and kind of makes the picture a little bit rosier?
In terms of the year that tech has had, is there a sense of surprise that these companies are holding up in the way that they are? It's fundamentals and the kind of the bigger picture, the macro story. And I'm sometimes confused as to how you treat a tech company, these big tech companies. Are they defensive? Are they safe? Are they growth companies? Are they dependent on what's happening with the rates market? What's happening with earnings? I'm still struggling with how and what the market is using as a benchmark.
I think a really good metric that people are following, we had Mark Mahaney from Evercore on the show yesterday talking about exactly this, is how do these deep cuts and deep layoffs that are unprecedented levels for these particular names, are they actually showing a return on the bottom line? So if you think Meta as an example, Meta doing just tens of thousands of layoffs since November of last year, well, they've had 4 sequential quarters where margin has declined. We actually expect to return to margin growth in this quarter, a direct impact of the efforts that they've done around cost cutting. That's where the potential upside would be, because it actually, if it shows that they can get more financial improvement from those cuts and cost-cutting exercises, that's how you could differentiate yourself in this season of all earning seasons.
Ed, it's always great to catch up. We're looking forward to the show a little bit later on. Ed Ludlow, you can of course catch Ed, co-host of Bloomberg Technology. That show coming up in around 90 minutes, noon Eastern, 5 p.m. here in London. We're going to talk next about consumer confidence and what does that mean for shopping habits. This is Bloomberg.
We're about an hour into the U.S. trading session. We're trading a little heavy right now in the equity market, and S&P right around the lows of the session off 0.7%. Abby's tracking the moves for us. Abigail?
Yeah, it's looking kind of ugly here, Alex. We have the S&P 500 down about 0.7%, the NASDAQ down more. You can see the KBW Bank Index down more than 2%. We'll be taking a look at one reason why. S&P 500 also dragged on by First Republic, but take a look at the weakness for China Tech, down another day, down 3.1%. We'll be digging into that further. It looks like there's some Chinese officials who are maybe talking down the rally that we had seen in China. Turning to First Republic, this is quite a chart because it's a 2-day chart, but we're looking at the 1-day plunge. So down 26% as First Republic puts up a very disappointing quarter, especially relative to deposits, coming in 41% down on, I believe it's a sequential basis, really missing estimates. They're also talking about cutting staff and looking at strategic alternatives. The stock trading at an all-time low, or it had been earlier at least. As for China Tech, well, you know, it's down, and actually this is not China Tech. We're looking at industrial metals rallying relative to the stock 600. So let's take a look at U.S. earnings movers here in the U.S., and we're going to see, we're going to be taking a look at the leaders in this session only because we were looking at that first board to the downside. PepsiCo up 2%, a great quarter. They also raised their outlook. It looks like consumers are now really looking past these rising costs and prices going higher and allowing some of these companies to raise prices. 3M up 1.1%. They are cutting staff by another 6,000. That could save them $900 million. Pulte Group up 2%. We just had those new home sales come in above. Pulte put up a really great quarter. And then finally, Kimberly-Clark, similar to PepsiCo, up 2.4%, having to do with the fact that we have consumers, once again, just paying up, looking past the rising prices and not pushing back.
Yeah. It's fizzy drinks, it's snacks, it's something to wipe up the crumbs with. The consumer continues to pay up. The margin story, the top line, I think looks fascinating. Volumes are down, but nevertheless, these companies continue to crush it. We're going to talk to PepsiCo very shortly. We were having an interesting conversation with the CFO. Abby, thanks very much indeed. Let's carry on the conversation about the consumer right now. U.S. consumers broadly feeling a little bit more pessimistic about where the economy is going. Right now, though, they're feeling okay. We're going to get some more insights into how that's impacting spending when Visa reports numbers after the bell. Joining us now to discuss what we should expect is Lisa Ellis, Senior Research Analyst at MoffettNathanson. Lisa has an outperform target on Visa. She's got a price target of 250. The stock just hit a 52-week high of 234, so not too far away from that price target. Lisa, great to see you on the show. We're about to get Visa numbers. Expectations are high. As I say, the stock just hitting a 52-week high. What are you going to be listening for to hear about whether or not this momentum can continue?
Yeah, so the number one number, of course, is that volume growth number. That's the indicator of consumer spending. You know, keep in mind, in the United States, well over 60% of all consumer purchases are made with a card, and Visa is 2/3 of that. And so they are a very broad-based view into the health of consumer spending. And so far, the data points we have so far, as you were highlighting, are quite positive, including in payments land. American Express reported last week they beat by a couple of points and highlighted in particular the strength in travel and entertainment. Their travel and entertainment business was up 30% year on year as people continue to get out there, get back on airplanes, get out to those, Taylor Swift concerts, et cetera, coming off the pandemic. And we're looking for a similar number like that out of Visa. If anything, I think they're probably biased to beat modestly this afternoon.
On the flip side, though, Lisa, I mean, you're not going to go, I guess you could, but in terms of what people are buying at the grocery store, et cetera, are we seeing a rise in using credit cards to buy everyday stuff? And when does that become, bad?
Yeah, that's a very good question. Everyone is watching those consumer credit balances really carefully. They are back now to above pre-pandemic levels, but the charge-off rates and the delinquency rates, while increasing slowly, are still well below pre-pandemic levels. So the benefits that consumers saw from stimulus fund, all of the stimulus over these last few years is still helping them, right? It's still sitting in their bank accounts. So while it's creeping up, it's not yet at a level that we would consider to be concerning quite yet.
Lisa, the Chinese are only just getting back to traveling. When they do, they are likely to do so in a big way. How much of a tailwind is that going to be? How much more still is there in this visa story when it comes to travel?
Yeah, that's a great question. So pre-pandemic, international travel and also like online buying, internationally was about 23% of revenues. It's very high margin, very lucrative business. It's still only about 18% of revenues. So that gives you a sense of it. We've still got about 5 points, to come back in. We were expecting 20% growth this quarter. Based on what we saw out of Amex, that number could be closer to 30%. And like you said, a big part of that delta that we're still waiting for is coming out of Asia. It's China and other parts of Southeast Asia where, folks are still kind of getting back out there post-pandemic.
I just want to tie this in, Lisa, to the consumer confidence data that we got at the top of the hour. So expectations slid to the lowest in July, yet they expect to make more money. So people expect to make more money than they did in March, but the next few months, they don't feel great. How does that data get reflected in Visa spending, and how do they kind of capitalize on that confusion?
Yeah, I know, right? The mixed signals. Look, job growth remains healthy, right? Wage growth remains healthy. Like you said, people are still making more money than they were last year and were year on year, and yet they're very nervous about what's to come. They're seeing all these headlines around layoffs, right? Maybe they're starting to build up their credit card balances a little bit again. So some of the data points we see, and we'll get more insight from Visa today, but out of some of the other players that have reported, folks, while they're still spending, we are starting to see a little bit of signs of trading down, so less fine dining, more quick service restaurant, for example, more Walmart, right, a little bit less high-end retail. Not broad-based, but the early signals, and and that's a little bit of that. I think they've got the money, they're still out spending, but they're a little nervous about the future, so they're maybe going to the less expensive restaurant, not splurging quite as much.
Can you just give me an idea of the demographic around that? Are we starting to see middle-income families doing that? We've obviously been watching them very carefully. They continue to spend. Are we finally seeing cracks in that particular demographic?
Yes, I think that is what we're seeing. If I just look and compare, for example, American Express, which is very affluent, of course, very skewed affluent, their numbers on the consumer side really strong. But for example, they also have a large small business segment, which actually does get at that mom and pop kind of consumer, the more middle income consumer that's maybe running a local nail salon or something like that. And that growth was one of the weaker spots. So I think we might be starting to see some hints of a bifurcation like you're highlighting, where the middle income consumer starting to trade down, they're nervous, the multi-year inflation effects are starting to, now they've lapped, right, the elevated inflation, it's really starting to hit the pocketbook. And yet the high-income consumer that's still sitting on a lot of savings, is still booking that trip, right, that they skipped over the last years. There's a little bit of bifurcation. I wouldn't say it's dramatic yet, but I think we're seeing hints of it.
Right, it's beginning. So Lisa, Guy was mentioning that Visa hit a 52-week high last week. Your price target's 250. What's going to be the catalyst to get us up there now?
Well, in addition to this whole, dynamic that we're describing, the other really important thing for Visa is their penetration of other payment types beyond just that consumer spending at the point of sale. But as I highlighted, in the U.S., over 60% of consumer spending is already done on a card. That's lower globally, so there's still plenty of runway, but increasingly investors are watching for Visa's progress in some other, what they call new payment flows, things like commercial payments, things like disbursements, like your cashing out by an Uber driver, some remittances. There's these other payment flows that are call it 15% or so of their volumes and revenues, which are an increasingly critical part of the bull story for Visa when you're looking out over a multi-year time frame.
Lisa, we love talking to you. Thank you so much. Wonderful insight to set us up. Lisa Ellis, Senior Research Analyst at MoffettNathanson. All right, coming up, staying with earnings, you got GE delivering a profit beat and boosting guidance. It's aiming to more than double earnings this year. We're going to take a look at how they're going to do that next. Also, the stock down by about 2%. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Lisa Mateo. President Biden is asking voters to let him, quote, finish this job. The president has formally announced that he would seek re-election next year. In a video released today, he said there is still work to do to give Americans a fair shot. The president criticized what he calls extremists in the Republican Party who want to cut government spending and curb abortion rights. British Prime Minister Rishi Sunak wants to leverage the country's improved relationship with the European Union. Bloomberg's learned Sunak wants a deal to make it easier for Britons to travel to the EU. He hopes to reach an agreement to let Britons use Europe's e-gates for passport checks, which would speed up border crossings. And singer, actor, and civil rights activist Harry Belafonte has died. A spokesman says he died today at his home in New York City of congestive heart failure. Belafonte's recording of the Banana Boat song propelled his career in the 1950s. He was at Martin Luther King Jr.'s side for his I Have a Dream speech in Washington in 1963. Belafonte was 96. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Guy.
Lisa, thank you very much indeed. General Motors beating first quarter profit estimates and raising guidance for the year. But the automaker still is facing economic headwinds, and EV competition, of course, from the likes of Tesla is a big deal. GM CFO Paul Jacobson joined Bloomberg Television earlier today to address some of those challenges.
When we're looking at EVs, you know, we have really strong demand for everything that we've produced so far, and when you look at the order backlogs and the ramp up of cell capacity, we feel good about our ability to ratchet up production to meet that demand. But you know, consumers are speaking with their commitments to us, and we feel good about the products and the vehicles that we're producing. The Hummer EV is just it's a great vehicle engineered by our team.
Here we go.
And customers can't get it fast enough.
You know, I look at this, Paul, and it is unit and price. Mr. Musk is playing with price, it seems like, on a weekly basis at Tesla. I was talking to our David Welch in Detroit. It's real simple. How do you adapt to Tesla's price strategy? Is it something you react to? Is it something you ignore?
So we've actually been very consistent with our pricing on our EVs, and that's really a function of the demand that we've seen for them. So, you know, there's been a lot of industry noise around pricing all across the world, and it's something that we've been very consistent with our strategy, and it's one that consumers are responding to. Over the long term, obviously, we've got a competitor that is posting really strong results, really strong margins. We need to make sure that we lower our costs, especially our structural costs, and we're aggressively getting after that. We announced a $2 billion program. Today, we're talking about being at the high end of that range in 2023, getting about $1 billion out this year, with the other $1 billion to follow next year. And it's just the first step in the process of making sure that we're competitive for the next generation.
Does cost savings mean layoffs?
We're actually not doing any layoffs, Lisa. So we, at the end of the day, we had a voluntary severance program. We had over 5,000 of our colleagues opt either to retire or to move on, and that alone is going to save us about $1 billion in the run rate. And that's something that we think we can manage through and hit our goals on our $2 billion program.
You reported full-year expectations, Paul, that exceeded what a lot of people were anticipating. How much does this hinge on North America and not on China? How much is this completely independent of an international story and very much U.S. focused?
Well, the bulk of our business is obviously in our North America segment, and we had a really strong quarter there. Pricing is still up as we see wholesale prices are still lapping the increases we had last year that we put through as a result of the higher input costs, and demand still remains strong. So our volumes were up about 4%. Our inventories were flat, and I think the team's doing a very good job of managing through that. We've planned for the year, and we alluded to this in our guidance at the beginning beginning of the year that we were assuming a 15 million unit market here in the U.S., and we came in slightly above that. But, we've got some cushion built in case we see demand start to fall off in our expectations. But when you look at our first quarter outperformance and the confidence of our cost reduction plan, we felt comfortable raising the guide. Now, China, obviously very competitive. They're still coming out of COVID, and we see demand recovering, but it's also an incredibly competitive market. The team there has done a great job. We were able to maintain profitability in Q1, but we think second quarter is going to be a little bit challenging, and then we'll start to see some improvement in the back half of the year.
That was Paul Jacobson, General Motors CFO on Bloomberg TV earlier today. So GE also does the beat and raise. First quarter earnings beat and improving its guidance for the full year. Stock down, though, by about 1.3%. It did hit a 52-week high earlier in the session. Here with Morris Brooks Sutherland of Bloomberg Opinion. If we just look through the intraday action, solid quarter?
Oh, no, absolutely. I mean, and don't sleep on the fact that this was their first quarter of positive free cash flow since 2015. This is a huge landmark for GE, which typically has been back-end weighted on the free cash flow front. It's just sort of the nature of some of their business, but they've talked for a very long time about trying to smooth some of this out. And so this is a big accomplishment and really speaks to the work that they're doing operationally to make these businesses nimbler and more focused on cash.
Brooke, let's talk about new engines versus old engines. Is GE now an old engine business? I.e., you talk about the cash story, you sell a spare part, the margin on that is great, and that seems to be what's driving the company at the moment. How long does that last for?
I mean, I think that's a big tailwind for them. I think, when you look at the airlines, they're very desperate to fly as many planes as they can to capitalize on the demand that they're seeing, and we have a backlog of servicing those engines that are out there. And I think there's a real opportunity for the aerospace manufacturers in the aftermarket. Now, we have seen retirements tick up a little bit, which does start to pressure some of that, but this has remained a very robust market for the aerospace manufacturing. I think that GE is still a new engine story as well, though. They're talking about significantly ramping up LEAP output if only they can get their supply chain to cooperate. So it is a bit of both as far as GE is concerned.
What's the read-through for Boeing? I'm going to ask Guy's question.
I mean, I think the big question for Boeing is what is up with the 737 MAX and how big of the impact are we going to see on deliveries from this latest hiccup with Spirit Aerosystems that has to do with the rear fittings of the plane that attach to the vertical tail. We don't really know yet how significant this is going to be, but of course the question is always for Boeing, when does the bad news stop? When do we finally get to a point where we're at stability? CEO Calhoun came out and says he doesn't expect this to impact their ability to raise output of the MAX, doesn't impact their long-term free cash flow goals. I think the question is, can you believe him at this point?
Yeah, and how long has the MAX still got? May need a new aeroplane, but they're not quite there yet. Brooke, can I just ask you a question about 3M? Why is 3M down as hard as it is when it continues to cut costs, which other companies are being rewarded for, but 3M isn't?
Because this is the latest in many restructuring initiatives that we've seen from 3M, and they're all sort of focused around the same idea of streamlining the operating model, streamlining the supply chain, pushing more responsibility down to the business units. We haven't really seen any of these past restructuring initiatives pay off. 3M's operating margins have been moving relatively sideways. It's divesting some businesses, and yet we're not really seeing the operations of this company respond to these restructuring initiatives, and I think that begs the question of what are they doing exactly, and how enthusiastic should you really be about this latest cost-cutting initiative as far as its impact on margins? I think the onus is on the company to prove that this will have the impact that they've long been talking about here.
Do they need strong demand, though, to help them do that? I mean, they make so many things. They're going to be exposed to so many different parts of the economy, like Post-its, respirators, etc.
Well, I mean, I think that's always been the issue, that there's always some sort of offset to these restructuring initiatives, whether it's COVID, whether it's supply chain problems, the strong dollar, China being weak, whatever it might be, which does raise the question of whether 3M is too diversified. Now, they've significantly simplified in the last couple of years from going, basically from doing no kinds of spin-offs or divestitures, so they've now merged their food safety unit with Neogen. They're spinning out their healthcare business, but it remains one of the more diversified industrial companies. Now, of course, their bigger issue is the pair of legal headaches that they have with the military earplugs and PFAS. Now, you can't really solve either of those by breaking the company up, and one would argue that you need need to keep a certain amount of assets around to pay what could be a very large legal bill in both of those situations.
Brooke, always great to catch up. Looking forward to reading the opinion pieces. Brooke Sutherland, the Bloomberg Opinion. Thank you very much. This is Bloomberg. So we're about to come to the end of the day here in Europe. I love days like today. Days like today are about not the headline. It's about what's happening in the bottom-up story, the single stock narrative. It's not about what's happening at the index level. Look at the stock 600. Look, it's doing nothing. We're drifting sideways. Another session where we're basically just doing nothing, down by 0.5%. But within that, there are some fantastic narratives that I think are really worth plugging into. Look at what is happening within the European industrials today. Pick your name. ABB, Asia Brown Boveri, having a cracking session. Alfa Laval up by 3.6%. There's some real strength in this area today, and you're seeing it across Europe, and I think that's fascinating to see what is happening there. Then you take a look at what is happening in the banking sector. UBS, I know there's still a lot to come, and I know there's still a lot to book when it comes to the CS deal, but digging within the UBS numbers I think is absolutely fascinating. Manis is going to join us from Zurich in just a moment. We're down by over 2%. Net interest income guidance was not as good as anticipated, and I think that really is something to speak about. We should do that in the next hour. In fact, we are going to do that in the next hour. We're going to talk about the fact that maybe actually this story, this tailwind from this rising rate story, maybe is beginning to abate. Maybe that's a narrative for later on this week when we get Deutsche Bank, when we get Barclays, I think coming out on Thursday. So I think there's some really interesting narratives coming through here. I think the industrial story out of Europe is really interesting. The consumer story with Nestle as well, absolutely fascinating. Anyway, European Close is coming up next. This is Bloomberg. Tuesday, the 25th of April, we are awash with earnings. That's the narrative. It's a bottom-up market. Take a look at what is happening with single stocks. Nestle and Verve, really strong numbers. We're going to talk to PepsiCo later this hour about what is happening with consumer goods. The banks are fascinating. European industrials are having a really strong day today. We need to cover it all. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So the story is below the surface. It's not at the index level. The stock 600's down by 0.4%, but that tells you absolutely nothing. Take a look at the single stocks. Nestle, you've seen it with Coke, you've got it with PepsiCo today, you've got it with Nestle. These are companies that are able to push through pricing and the consumer is taking it. That's the narrative that is driving that sector. That stock up by 0.7%. But the banks, I think, are also absolutely fascinating right now. Net interest income, well, the guidance there at UBS was a little weak. That seems to be a problem. We're getting deposit outflows for Santander in Spain. You've got a bit of an issue in Brazil. The market is marking these stocks down reasonably aggressively. Santander, Alex, down by nearly 6% today.
Yeah, Guy, it's also earnings crazy here in the U.S. Now, we did get some data at the top of the 10, and the S&P is up by 0.6%. But the data was kind of okay. New home sales did really well for April. And then in terms of consumer confidence, we don't feel really good. Expectations aren't great, but it looks like everyone's still expecting to make more money. So somehow that doesn't really square. So it's hard to find a narrative when you're parsing through all these numbers. So I tried to do it for you. So on the one hand, you have Kimberly-Clark up by about 2.5%. The company is still able to pass on price increases. The consumer's handling it. They still see, though, inflationary pressures continuing. They did a typical kind of beat and raise. This feels like the consumer staple-y kind of things. You're willing to pay up for the stuff that you really need. Okay, that's one thing. Then you got UPS falling the most since 2015. Volumes are disappointing. And I chose these two because it does fit into the narrative of the consumer holding up okay. It may not feel great, but we're definitely not buying extra stuff. And therein, I think, lies something that we're going to continue to see throughout earnings season. Now, the 10-year yield down 8 basis points. This is kind of where we were when we started the session anyway. It felt like a little bit of a risk-off feel within the bond market. But underneath, it's really interesting when it comes to those numbers, Guy.
It is, and what you're getting is single stock volatility that is quite extreme. Headline volatility, not so much, but I think the banking story is really emblematic of what we're getting here. If you take a look at the numbers today out of some of these banks here in Europe, they don't actually look that bad, but the market is picking them apart and looking for signs of weakness. Net interest income guidance for UBS is being punished. That stock is down by 1.9%. Santander, you've got to go looking for the bad news, but the market seems to have found it. That stock is down by nearly 6%. The banking sector more broadly, we're heading into a big week for banks. It's already down by over 2%, Alex. The market is looking through these banking numbers. It's trying to figure out where these institutions are going next. Are some of the tailwinds that we've seen that have been driving this sector beginning to abate?
Yeah, and parsing through all of that is the fun story around UBS. So let's go with it. The Swiss lender saying it attracted about $28 billion from wealthy clients in the months running up to its takeover of Credit Suisse. So Sergio Armati, now the CEO again, sat down with Bloomberg's Manus Cranny for the first time since the deal with Credit Suisse.
At times of distress in the market, generally the first quarter was very challenging. We still saw clients looking at UBS as a safe haven, and the inflows were coming in from all regions and from different sources. And in that sense, we are very pleased that particularly also after the announcement of the transaction of the acquisition of Credit Suisse, we still saw inflows coming into our bank. So a sign of confidence of our clients.
The chairman guided us at a number of times that the integration would take 3 to 4 years. Is that a low ball and a low bar? Or again, is that a reasonable guidance?
I think it's reasonable guidance. I mean, this is a complex transaction. I think that's, but it's also a transaction that will offer a huge opportunity, not only to our shareholders, but also to our clients. The two franchises are extremely complementary, and in many areas, and also to our employees. But in order to fully execute a transaction of this complexity, it takes time, and we have to do the things in the right way. We should not hurry into doing things that's and just for the sake of closing the transaction in a couple of years earlier.
Mr. Amosi is back. Fascinating conversation with Manus Cranney. It brings us into our question of the day. In some ways, UBS is idiosyncratic. It's got its own issues to deal with right now with the integration of Credit Suisse, but in some ways maybe it is emblematic of a European bank story that maybe is, as Manus Cranney just put it to me in the break, running out of puff. The net interest income story that has driven some of these banks as rates have gone higher, maybe that's beginning to fade, and maybe that was one of the reasons why UBS was tracking lower today. So that brings us to our question of the day. Are European banks overrated? Get it? Are the rates beginning? The rate story, is it beginning to fade? Joining us now is Manus from Zurich. Tom Metcalf joining me now here in the studio. Manus, I looked at what the company had to say today. I looked at what UBS had to say today, and most of it sounded pretty good and pretty reasonable. Why is the market marking this stock down as much as it is?
I think it depends which group of people pressed the sell button this morning to take the stock down by 5%. Was it the group of people who weren't sated enough with a narrative around the buyback, integration and timelines? In other words, they wanted more, but the reality is, Guy, the deal hasn't even closed. So that could be one of the reasons. The net income dropped by 50%, but there's a huge 15-year legacy issue in terms of taking provision for retail mortgage-backed securities. My sense is this, just on rates, and you want to lean into the rate story, is that they saw that continued move to money market funds, their own money market funds. Net interest income in the wealth management business, Guy and Alex, was up 31% in the quarter. Now, when I said to him, do you think rates will top out at 5%, maybe get to 6%, as some people are speculating, he said, the only reason you're going to get to 6% is if the inflation story does not roll over and roll down. And I think therein lies the point. If you're making your net interest income assumptions based on the forward curves, which suggest one more rate hike and done, then perhaps this is peak NIMs. I like what our money had to say, which was, look, if we've got to get to 6%, then it's more about inflation being uncontrollable at that time, and it's better to have a short, shallow recession, I'm paraphrasing, because the social cost of embedded inflation is much more brutal. Alex?
Yeah. And we'll have other problems if we have to get to 6% there, for sure. Hey, Tom, is that what we're going to see? Is this like peak NIM? Is this something we're going to have to grapple with?
Well, I think it's certainly what a lot of investors are kind of looking at. It's going to be an interesting sort of set of results, because banks might be having pretty positive Q1s, but the guidance might well be like, you know what, this is the peak NIM, as Manus just said. So I think that's one of the big things. And one thing I was thinking, I was looking at those big drops at Santander, and I know UBS dropped, I think initially 5%, has recovered. Maybe there's also a bit of spillover from the US, very different banks, but that First Republic earnings has maybe just really hurt the sentiment, and that might be why you're seeing sort of the investors kind of react like they have today.
Can you just explain to me why this is so important? If net interest income is about as good as it gets right now, and the guidance is that it's going to get a little tougher from here, can you just walk me through what impact that is going to have for investors?
Well, yeah, it's just all on the bottom line, right? It's the future. That's what people are buying in the stock market, and you know, it does seem, when you look at it, you know, there isn't that much further for interest rates to go, at which point those margins, you know, will flatten, will squeeze, and then, you know, the banks again have to get back more onto sort of cost cutting as opposed to sort of seeing the top line rise. So it makes everything harder, and obviously you've also got, you know, rise in provisions. So basically you could see, you know, narrower profits, or certainly just less of the good story that you've had over the last, I don't know, 4 quarters with banks.
Yeah, and that's basically what we wound up seeing for UBS too in terms of client activity. Manus, the U.S. banks talked a lot about how they're worried about a recession. They're thinking they're going to have a downturn, but we're not seeing it in the numbers yet. Did Armani give you any clues of the yet part?
By the end of the year.
and certainly the tonality, it was a short part of the conversation, because I think the macro backdrop is the number 3 in the line, ironically, in this story with UBS. He thinks there will be a slowdown towards the end of the year. I think the more material issue here is really about where are the funds flowing to. That is the issue. $28 billion of net new money came into the bank, $7 billion in the 10 days after the deal closed. But here's the kicker, Alex. You have your very own home-baked, homegrown banking crisis in the form of SVB. Net new money of $28 billion, $8 billion came from the United States, and he emphasized that in terms of where he saw the flow coming from a myriad of sources. So as he said, a shallow recession is something that may have to be politically accepted and tolerated to bat back against embedding inflation.
Can I just ask Tom about what the read across is from what Manus is talking about, what we saw from Santander today in terms of Barclays, in terms of Deutsche, in terms of BBVA. Other big banks are going to be reporting this week. Are we going to hear similar things?
I certainly think on the retail side, right? You know, you've got the NIMs, you know, what is, say, in Britain, you know, the rates are slightly different in terms of where they are at in the EU and the UK. UK is actually probably slightly further ahead because the Bank of England started raising earlier, so there's a little bit more pessimism around there. But I think really, ultimately, when it comes down to the bank, there's an individual story for each, right? With Santander today, you had to dig in, and then there's that concern around Brazil. For Barclays, people are probably going to look at the investment bank in particular, how are those traders doing? And, you know, BNP Paribas, massive bank, how are they doing really across the whole spectrum? And then you turn to an HSBC. For me, I'm looking there is what's happening with its top shareholder, Ping An. So lots of different stories across the bank against the wider macro picture of, you know, maybe the sort of, it's going to get tougher times ahead.
Yeah, it's like a double whammy. Just take a look here. First Republic down 28%. Talk about idiosyncratic, guys. Thanks a lot. Really appreciate it, Manus. Thank you for staying late for us. Manus Cranny in Zurich and Tom Metcalf in London. Thank you both very much. So coming up, we're going to continue that conversation. Are European banks overrated? And then what it winds up meaning then for the ECB? Like if we're at peak rates, now what are we going to do? James Athey, Aberdeen Investment Director, will be joining us next. This is Bloomberg.